In this video, we continue our discussion on capital asset pricing model and start talking about the building blocks under the capital asset pricing model, the key ingredients of what goes into the capital asset pricing model. Right now, we have already discussed why a hurdle rate is necessary and how do we arrive at a risk return framework and why CAPM is one of the most commonly used frameworks that is available. Let's, before we go ahead, discuss the broad limitations of capital asset pricing model. Right now, the basic criticism of CAPM is that it makes some sort of unrealistic assumptions. What are those assumptions? It makes assumptions like there is no transaction cost, right? It makes assumptions with respect to marginal investors being well diversified. We have seen this earlier. It makes assumptions in terms of lending and borrowing with respect to the risk-free rate. You could borrow and lend unlimited amounts on risk-free rates. The second problem that comes with CAPM is when you're calculating data around some of the parameters such as risk premium or some of the parameters such as risk-free rate or the beta. You could have a problem with what is the market index chosen. Whose returns are you looking at when you are trying to calculate some of these? And finally, remember the model basically says that the expected return is nothing but the risk-free rate plus beta into the return on the market minus the risk-free rate, this being the equity risk premium effectively, right? Now, if this were correct, then there has to be a sort of a linear relationship between the expected return and beta, right? So there should be a linear relationship in practice when you see that. Theoretically, that is what CAPM tells us, but in reality, betas are not able to explain stock movements. There are a lot of other variables like what is the size of the company, what is the price to book value, what is the valuation. We'll discuss some of these as we go along, but basically some of the other risk parameters explain differences in returns better, right? So for example, typically a high beta stock should show better performance over a period. Now, what are high beta stocks? Metal companies, right? The likes of Tata Steel, the likes of Hindalco will have a high beta, right? Even real estate companies, the likes of DLF, etc., will have high betas. Now, it is expected that these companies will perform better over a period of time, but history does not seem to suggest so. So while CAPM is a simplistic model and we kind of use it, it is always useful to be aware of the issues that CAPM faces in real life, right? Let's then go ahead and now break it down into its three major components, and this particular section is going to talk about the first component, which is the risk-free rate. So there are three components: the risk-free rate, the equity risk premium, and the beta. We are saying the risk-free rate is the rate that is anyway regardless available to us in the markets. If we want to invest in the equity markets, we want an extra return for taking that extra risk that's given by the equity risk premium, and then individual stock specific risk that comes to the portfolio is what is called as the beta, right? So we need three major inputs. The first input is the current risk-free rate. Note the emphasis on the current risk-free rate that is needed. The second input is the expected market risk premium, not necessarily historical risk premium. This is the premium expected for investing in risky assets, the market portfolio versus the riskless asset, right? And then the beta of the asset being analyzed or the stock that is being analyzed. So that's what is going to kind of give us broadly what is going to be the expected return. Just simplistically speaking, if we say risk-free rate is 10%, just for argument's sake, and we are saying equity risk premium is 5%, just for argument's sake once again, we are basically saying that a stock which has a beta of 1 will give us a number of 15%. We are expecting a 15% return there. A stock which has a beta of 0.5 will be 10% plus 0.5 into 5%. So we will be happy with a 12.5% return there. And a stock which has a beta of 2, we would want a return of 20% on that, right? So we perceive the risk as higher. That's the broad contour of each security, and each security will be defined by one single parameter, which is the beta, right?